All right, how's it going, everyone? My name is Amos, and we're about to do a recap of how some dividend compounders performed during their earnings last week. These were the highlights that I had on my personal list. We're going to talk about that. And if you're wondering why I'm wearing a puffy winter jacket right now, it's because I'm freaking cold. And that's because I live here in Japan, and because it's March, pollen season is upon us. And I'm telling you right now, I lived all over the world before, and pollen has not been this severe for me until I moved to Japan in 2022. I'm telling you, the pollen in Japan will slap you so differently. Usually, in the States or wherever I was in Europe or other parts of Asia, if there's a lot of pollen in the air, I'll have a sniffle. I might sneeze a little bit. But in Japan, I'm talking about my eyes are bloodshot red, and my throat is itchy beyond belief. I can't breathe. My sinuses are clogged up. And so as a result, right now, I have all of my heaters off. Because if I turn it on, it shoots, I'm talking about millions of particles of pollen all over the house, and my allergy symptoms just go through the roof. Reason being is some wise guy, 100 years ago, had the bright idea of planting a crap ton of cedar and cypress trees all over Japan, to the point where every spring, now it's like a catastrophic event. I'm not even exaggerating. To the point where a lot of the Japanese workers, if they work for a corporation or a bigger company, the employer will literally give them sick days so that they can work from home instead of being in the office coughing and sneezing all the time. And for the ones that are in the tech industry, they even offer you to work from home or to vacation work in Okinawa. That's how bad the pollen is here in Japan. Dude, it sucks. It's 32, 31 degrees Fahrenheit. I have to wear a freaking winter jacket in my house because I can't even turn on the heater. Crazy. Anyways, the first one that we're going to be talking about is Domino's. As you can see on your screen, Domino's Pizza announces fourth quarter and fiscal 2024 financial results. I'm going to tell you, they missed on the EPS and revenue estimates by 1%. However, it's the sentiment and guidance that was really good. So all in all, I would say it was a very bullish earnings report. And let's talk about it, right? They gained 1% market share in the pizza space. That means they took away from the competition. We talk about Little Caesars, Pizza Hut, Blaze. So that 1% might seem insignificant, but in the eyes of investors in Wall Street, they really liked it. What else happened? They launched 2 new products that have been well received by the consumers. Talking about the mac and cheese pasta and the New York style pizza. And just look at this, right? Global retail sales, meaning the US and international franchisees included, 4.4% for fourth quarter. But for the entirety of 2024, it grew year over year by 5.9%. And when we look at just the US sales, then it was 5.3% year over year for the entire fiscal year, which I think is pretty good. Case in point, if we scroll down right here, you could see US stores, 5.3% year over year. And the leadership team also decided to increase the dividend payout by 15% year over year. Dude, Domino's Pizza, absolutely a dividend compounder with cheese, but it wasn't all fireworks and roses and rainbows. Because they also announced that they're going to be closing 200 stores in Japan because those locations are struggling. And where I live, there's a few Domino's pizzas, and to be honest with you, there's 20 different pizza chains in town, and whenever I drive by the Domino's one, it does not look too busy. So it makes sense from an anecdotal level. And just in case you're not informed, Warren Buffett went really big into Domino's Pizza last quarter into Berkshire Hathaway. He feels pretty bullish about the future of DPZ. And just to look at the numbers, the estimation was $4.90 for their EPS. Instead, they reported $4.89, which was a miss of 1 penny. Same exact story with the revenue. They were expecting $1.48 billion. Instead, they posted $1.44 billion. Next up, let's talk about Realty Income Corporation, the monthly dividend paying REIT. I'm going to be completely honest with you, I love this company. I love the monthly dividend, I love the financials, the fundamentals, the economic mode. But anyways, how did their earnings go? Well, the leadership team, super positive, and the sentiment was pretty bullish towards the future, and they reported that year over year, their AFFO went up by 4.8%, and they were able to maintain an occupancy rate of 98.7% by the end of the year, as you can see right there. And rent recapture across 833 renewed leases was above their target of 105%. What else happened? They ended the quarter with $3.7 billion of available liquidity, which I think is pretty awesome because they can turn that into dividends for you, or they can use that extra cash on hand to acquire another REIT, which not too long ago, they just acquired another REIT known as Spirit Realty Capital. So all of Spirit's properties became a part of Realty Income's at the closure of that merger. But something that I do want to call out is for 2024, their AFFO per share was $4.19. And just as a reminder, the AFFO in the context of a REIT is kind of like the free cash flow when we look at a normal company. But a REIT is not a normal company because they have to pay out 90% of their taxable income as dividends. So with that in mind, $4.19 for the fiscal year of 2025, they're anticipating the AFFO per share to be $4.22. And if they're optimistic and everything goes their way, then $4.28. So worst case scenario, they're expecting the AFFO per share to only go up by 1.4%. That is something to be cognizant of. So even though this year was a smash hit and things were good, this following year they're anticipating their growth to slow down. So all that to say, in a worst case scenario by 1.4%, that means the dividend payout is probably only going to grow by 1.2 to 1.3% as well, which kind of concerns my right nipple because historically from 2009 to 2022, their average AFFO per share growth has been 5.4% year over year. So to estimate about a 1% and some change growth for this year, things are not looking too good. Now, I could choose to focus on how their future for this year is not going to be that great and it can be doom and gloom. However, if I remind myself of the facts and refer to their company history and data of how they've been increasing their dividend payout for about 30 plus years and their occupancy rate being 98.7%, I think they'll be okay. Because they're going through a temporary struggle of a high interest rate environment, which is not that friendly for real estate companies that need loans in order to acquire and buy out more properties. And that's why when it comes to BDCs or REITs or even MLPs, it's so important to only invest into the ones that are very high quality. Because when there's a storm or a sudden setback, the crappy ones are going to crumble and fall. They're going to slash their dividend by like 50, 60%. The share price is going to be decreased by like 50, 80%. But when it comes to a high quality company, they're going to sail past the storm just as they have for the past 20, 30, 40, 50 years. So if Realty Income, yes, I am a shareholder. Am I nervous? Not really, but I'm not excited either. I think 2025 is going to be another year where they're going to be relatively flat in terms of their share price and in terms of their numbers and financials. I guess we can expect for them to grow in the low single digit numbers, such as 1, 2, or even 3% year over year. But hey, at least it's still growing. The next company is going to be Keurig Dr Pepper, ticker symbol KDP, and they also reported their earnings, and it was overall bullish language from the leadership. They seem to be happy with how things are going so far. In terms of the numbers, their EPS grew by 8% year over year. They also experienced 10% growth in their sodas, mainly due to 2 brands under their portfolio, Dr Pepper. Big surprise there. And then number 2 was Canada Dry, the ginger ale soda, where I have not taken a sip of that since probably the 6th grade, which is pretty crazy to even say out loud. And they also generated $1.7 billion of free cash flow. Now, what I really like about Keurig Dr Pepper is their capital allocation and how they use their cash flow. So this is how they broke it down. They used $1.1 billion of that free cash flow in order to do share buybacks, and they also used the remaining cash to buy ghost energy. Of course, they use some of it to pay out the dividends as well. And that's why when it comes to good dividend compounders, you want to see them have a free cash flow, but also a proper and a sound capital allocation plan. If they're just generating cash and they just spend it unnecessarily, or they don't use it in a way where it grows the business, then they're ran by a bunch of idiots. But in the case of KDP, it sounds like they're doing the right thing. And elaborating on Ghost Energy, the recent acquisition, it opened the door for them to walk into the energy drinks sector. Because prior to that, they were mainly operating with sparkling water, soda, and coffee. But now they do energy drinks as well. Based on my stupid knowledge of Monster energy drinks, the energy drinks sector, very high margins, and it's growing in a way that would make your head spin. I'm pretty excited about that. Oh, the reason why I say I'm excited is because I own about 10 shares of Keurig Dr Pepper. I know. Only 10. I don't have a lot of skin in the game, but it is worth mentioning. So with the Ghost Energy acquisition, they now have 6% of the energy drinks market share, and the leadership team is forecasting with their supply chain and their operational knowledge, their goal is to be 10% of the energy drinks market share in the next couple of years. That's the goal that they have set for themselves. However, it wasn't all rainbows and sunshine. Their coffee division, it went down. The sales went down by 2% year over year. Which, to be honest with you, I don't blame the people. They're probably fed up with the idea of buying Keurig cups for their little machines that cost like 3 times that of just buying the raw coffee beans. This is all coming from a guy that does not drink coffee. And that's because my choice of death and caffeine is through the form of green tea. Especially here in Japan, dude, if you're not drinking green tea, you're an idiot. Some of the best and high quality green tea available around the world is here in Japan. So that is something that I picked up since living here. But anyways, in fiscal year 2024, their net sales, they posted $15.3 billion, which was an increase of 3.9% year over year. So it is a company that is growing, not at the highest growth rates, but it is a decent growth overall. And I said it before and I'll say it again. If you're looking at Coca-Cola but you think it's a little too pricey or overvalued, I still think that Keurig Dr Pepper is an undervalued version and a cheaper alternative to Coca-Cola. I'm not going to say it's the best drink stock out there, but it is solid. And after their earnings report, do I see myself selling out of my 10 shares? No, I'm going to hold on to it. And the cool thing is, after their earnings report, like 5 or 6 Wall Street analysts went on the record of increasing their price targets and reiterated that Keurig Dr Pepper is a buy. And I think 1 or 2 even said it's a strong buy. So I think they see eye to eye with me that with the Ghost energy drinks coming into their portfolio, I think Keurig Dr Pepper's future, it looks pretty bright. And the next one is going to be Nvidia. I feel like everybody and their ex-wife, I'm referring to most investors and YouTubers and everyone else on the internet, they've already talked about Nvidia and how their earnings went. But just in case you missed it, Jensen, the CEO, he was super passionate and enthusiastic about Nvidia's future, which I think calmed the nerves of a lot of investors. Although after they reported, they still went into the red by like -9%. Makes absolutely no sense. As you can see on your screen right now, their quarterly revenue was up by 78% year over year. They posted $39.3 billion. And mind you, that's only for the past 90 days or 3 months. To post just shy of $40 billion, dude, that is absolutely bonkers. And their data center revenue for the entire year was $115.2 billion, which is double from the year prior. And if you look at it just for the past 90 days, then it's $35.6 billion, which is up by 93% year over year. But something that I do want to call out is their gaming revenue dropped by a lot, which is a trend that was also shared by AMD. Their gaming revenue also dropped by a ton as well, which means as of right now for Nvidia, most of their revenue is driven by B2B rather than the consumers and the masses. It's their clients such as Google, Microsoft, Apple, the ones that are buying up their chips for their data centers. That's what's driving the growth story for Nvidia. And their guidance for Q1, they expect $43 billion, which is an increase of 9.4% quarter over quarter. Right now it's $39 billion, and they're saying, hey, we're going to be able to post $43 billion. The analysts on Wall Street, they wanted to see 85 cents EPS. Nvidia posted 89 cents instead. They beat it by 4 pennies, which is still significant. And when you look at the revenue picture, the exact same thing. Wall Street said, hey, could you do $38.1 billion? And instead, Nvidia was like, we'll do you better, $39.3 billion. And yet they still went on a sell-off, which I think is absolutely silly, but also hilarious. Because leading up to the earnings report, Nvidia was about $140 a share, and then after the earnings report, they're in the red by about 10%. Make it make sense. It doesn't. Moving on to the next company. The next company is Papa John's Pizza. Yes, it's another pizza business, and I actually own shares of it. Funny enough, how did their earnings go? Well, it was kind of mixed. There were some good and some bad. Papa John's announces fourth quarter and full year 2024 financial results. So their international sales were up by 2% year over year, and they're slowly building an economic moat in the form of customer loyalty. It's called a Papa Dough program, where you get digital credits per dollar that you spend on pizza. So if you spend like $100 on pizza, you get something like 5 points towards the free purchase, and you can redeem it for free pizza in the future, which I think they copy that playbook from Chipotle, Starbucks, and anyone else that has a loyalty program. You gotta do it. That's how you build repeat customers to come back again and again, because they want to work towards that free pizza. Gamification of your business model is something that a lot of the companies are finally catching on to. But anyways, by their metrics, they are seeing an increase year over year from 21% engagement from utilizing their loyalty program to now 50%. So more and more people are using that loyalty program in order to buy more Papa John's pizza, in other words, okay? They also opened up 300 restaurants in 2024. And when you think about all of the franchisee fees, that's going to be increased revenue for them. However, the earnings report wasn't all bright, because their North America sales, well, it was down by 4%. That is not good, friends and family. And for the pizza joints that are owned by corporate, they were down by 6%. By the way, if you don't know, sometimes Papa John's, Domino's, and all of these other pizza companies, they open up a company-owned restaurant into a new territory or new neighborhood, and once it's off and running and successful, they'll find a franchisee who can take over and then run that operation for them, and then they're the ones handling all the finances, operations, and then they just cut a check, the royalty check, to Papa John's or Domino's, wherever it is. That's usually how it works. They don't want the company-owned stores, but sometimes they have to do that until they can find a suitable buyer to become a franchisee. So if you were to break it down in any one of their portfolio mix, it's usually like 97% of their stores will be franchisee-owned and operated, and the remaining 3, 2, or even 1% will be company-owned, because the pipeline and the goal is to convert all of those company-owned stores into the hands of a franchisee. Because for most pizza joints, their business model is predicated upon franchisees doing all of the heavy work and lifting. But in terms of revenue, they were also down by 7% year over year for the fourth quarter, which is unfortunately a common theme with their EPS as well. So their financials and revenue, it's declining year over year, and this can partially be explained by the fact that the restaurant margins declined due to higher food ingredient costs. So I own a few shares of Papa John's. What am I going to do? I don't think I'm going to sell out of them. I think right now they're going through a pickle. It's a high inflationary environment. People are saying that the economy is slowing down. I think there's a forecast that just came out where Q1's GDP growth here in the US is going to be a negative number, which has every butthole on Wall Street sweaty, nervous, and panicking. And so consequently, when you want to buy a pizza and it comes time for you wanting to choose who to buy it from, do you really think you're going to buy a $30 large one-topping pizza from Papa John's, or do you think you're going to go with Domino's. I think they have an offer where it's like you can get 2 pizzas for like $6 each, something like that. Papa John's, overpriced, everyone knows. However, they are known to be the premium. I say quote unquote premium because I think it's all a marketing fad. There is no such thing as better ingredients, better pizza. I think it's been shown that the ingredients Papa John's uses is basically in the same territory and category as Domino's and Little Caesar. Actually, that was a lie. Objectively, I do have to place Little Caesar's ingredients below that of Domino's and Papa John's, because Little Caesar's is that place that you grab a pizza for $5 if you're super hungry. You know it's not going to be the highest quality, however, it does taste decent. But if you have all 3 of those pizzas in front of you, if we're going to be honest, I think Papa John's tastes the best. And then right below it, a not so distant, but very close second place is Domino's. And Little Caesar's is always going to be last. I mean, on their own, I think they're fine. I think they taste great. But if you have Little Caesar's right after taking a bite of a Domino's or a Papa John's pizza, it's not in the same territory. And then Pizza Hut. Dude, what the heck happened to Pizza Hut? I remember growing up in the 90s, man, every birthday party I went to, everybody had Pizza Hut because Pizza Hut was the go-to pizza brand. Because back in the day, 30 years ago, dude, Domino's was ass. Everybody knew it. Like, Domino's tasted like crap. And then in the 2000s, they had like a revamping of their operations, and their procurement team was like, okay, we got to stop buying the cheapest pizza sauce and the cheapest ingredients because our pizza tastes like ass. And they also changed their crust to incorporate the garlic flavor that it's known for today. But anyways, all that to say, dude, what the hell happened to Pizza Hut? They used to be so freaking good. And now I think you're better off just grabbing a frozen pizza than ordering from Pizza Hut. That's just my opinion. All that to say, man, why did I go on that ramble? Why am I not going to sell out of Papa John's? Because I think Papa John's is an otherwise very good company. I'm not going to say it's the highest quality, but I think it's good. I would categorize it as like a C+ type of stock. Not the best option out there, but it's far from being the worst. And I know right now, as they're experiencing a speed bump, setback, and this storm that they're trying to navigate through, I think it's a good buying opportunity. And I have to reiterate again, do not follow me into it, because I truly believe that Domino's is the #1 QSR pizza stock or business that you can own. Papa John's, not #1. Okay? However, I think Papa John's still provides good value, and I think it's undervalued. Speaking of undervalued, if you choose to stick around at the end of the video, I'll be sharing with you what price I think is fair to buy into these companies and what price I think they should be at in about the next 6 to 12 months. The next one is going to be Hormel, or Hormel, however you pronounce it. And their earnings had a little bit of good and a little bit of bad. They're posting modest growth, but not by much. Their organic net sales is up by 1% year over year. Not the prettiest picture, but hey, at least it's trending in the right direction. And they also experienced growth in their big brands, such as Spam. Yeah, did you know this is the parent company of Spam? In Hawaii and in Korea, it's not crazy to give someone a box of like 12 cans of Spam for Christmas or for like Valentine's Day. I'm not exaggerating. That's actually a thing. And they also saw growth in their Applegate deli meat stuff and the Black Label bacon. Now, my takeaway on what the bad part of their earnings report is the fact that their profit margin as of right now is 15.9%. And it's been on a steady decline since the pandemic, which is not a good thing, but it's explained by the high cost of operations, how every employee's wages have gone up, and the cost of goods is also more costly. And to be honest, inflation just sucks for most businesses. And their guidance for fiscal year 2025, they're expecting their organic net sales to grow by 1 to 3%. I know. Very small numbers, and no, I'm not talking about the size of your PP. This is not the prettiest picture, but hey, at least they're not saying something like we're going to decline or we're going to decrease. And to be honest with you, I own shares of Hormel, but I have not been buying up more shares. Reason being is that I see better value and opportunity in General Mills and Conagra brands. Because when it comes to those two food stocks, I would label them as a B-, like category and tier if I were to grade them. And for Hormel, I would say something like a C+. However, what I think is the most undervalued and best food business stock to buy right now, it would be PepsiCo. I would categorize and grade them as an A-. So I've been buying up a lot of shares of Pepsi, a little bit of General Mills, and I think I have 1 share of Conagra Brands. Yes, 1 share. Pretty hilarious. And then for Hormel, I bought into them a while ago. I am in the green, but I am not adding more shares as of right now. I think they are undervalued, but I see better opportunity with the ones that are higher graded and higher quality. All that to say, I don't think Hormel is ugly. I think it's decent, and that's why I'm going to continue to just hold on. And I know in the future they're going to be fine and dandy. And you might be wondering, why the heck are you buying food CPG stocks? That's because I see these companies like Hormel, Conagra Brands, General Mills as like that boring, safe, and steady businesses that I think in the future will continue to grow at a very slow year over year. But I think it's healthy and a good balance to include into a portfolio, especially if you want a good and decent dividend yield. These are business models that are not going to disappear in the next 10 to 20 to 30 years. Food and groceries are here today and it's here tomorrow. So I see them as a very boring business and as a good way to balance out my investments in Nvidia and AMD. Because those two, a little riskier, far more risk to reward ratio. But with these food stocks, I know what I'm getting myself into. I'm not going to expect it to go to the moon or to 5x in the next 10 years, but rather I am expecting, modest, small growth where the CAGR is going to be somewhere like, 8 to 9% year over year. And for me, I'm okay with that because I'm trying to build a portfolio that has a pretty good, juicy dividend yield through these boring companies that are stable, but also by acquiring some growth companies with a dividend as well. It's all about having a balanced and a hybrid approach. I'm not just investing into REITs. I'm not just investing into BDCs or just into tech. I invest into a little bit of everything because I see the merit and value and the good in every investing strategy. They all have a good side to the coin. Obviously, they all have their negatives and the bads as well, but I think once you pull them all together, I think the goods outweigh the bads. Dude, that sounded so stupid, but hopefully you get where I'm coming from. And the last company is Main Street Capital. Ticker symbol MAIN. This is a BDC that I've been eyeballing, at least for the past 3 years, have not been able to buy into them. Anyways, their earnings report, they just crushed. Absolutely dominated. Beautiful across the board. The only concern that they had is some of their portfolio of businesses might run into the potential impacts from interacting with Doge because their business model is contingent upon government contracts. If you've been seeing anything coming out of Wall Street Journal or the New York Times, you can see that a lot of the companies that rely on the US government for their revenue source, they're going on a sell-off and a dip. And I think it makes a lot of sense because I think we're far past that stage of just talking. I think the current presidential administration is walking the talk. Any company that relies on the US government for a huge chunk of their revenue, they're going on a sell-off. And for me, I think I see opportunity because that's not always going to be the case. Are they going to suffer in the next 2 to 3 years? Absolutely. And that's why I'm focused on the defense companies that get their budget from the DoD, because I think that's the one agency where this administration is not really going gung-ho about stripping all the money from. I think they are firing like the DEI titles and some of the civilian employees with the DoD, but for the military budget, like for the United States Navy or for the Air Force, I think that revenue is going to stay in place. And that's why I'm personally buying into Huntington Ingalls, and I'm still waiting to buy into Lockheed Martin. And now let's go ahead and talk about what I believe is a really good price to buy into each one of these companies. Now, for full disclosure, transparency, honesty, and love from my heart to yours, I'm invested into every single one of these except Main Street Capital. Main Street Capital is like, you know how everyone talks about the one that got away? Well, for me, it's the one that I just never had the opportunity to buy into. Because as you can see on your screen right now, I think a good price to buy them at is closer to their book value per share, which is $39.99. To be almost around $60, to me, dude, that's way too expensive, way too overvalued. And out of this entire list, my biggest conviction, like the one that I have the highest faith, sounds like a religion. What I mean is the one that I know is undervalued right now and in the future is going to compound. My highest conviction is Realty Income. I know. That sounds ass backwards for a guy that's in his mid-30s to say like, what, a REIT? Are you stupid? But their data and their past performance and their CAGR in the stock market has been impressive. Obviously, they are going through a depression right now. You know, their first breakup with their wife. She took the kids. No, I'm just kidding. But a high interest rate environment is kicking them straight in the nuts. Because I think easily, if the the Reserve, they decide to cut the interest rate, because I think right now the rumor and narrative on Wall Street is that the interest rates are going to go up, which kind of sucks unless you have most of your money parked in a high yield savings account and you don't invest into stocks and you watch this video because you're kind of scared of the stock market. Then you might be happy. But for most businesses, that's not going to be a good thing. If that happens, Realty Income is going to stay around $50 a share. But if for some weird reason, if the tariff wars work out in our favor, or magically we decide to cut by like 0.5% somewhere in 2025, I think Realty Income easily a $65 a share type of company. Realistically for me, I didn't want to put it on the screen because I feel embarrassed. I think in the next 12 months, if things go in their favor, I'm talking about the macro environment conditions, the high interest rate environment coming to an end, or I guess the light at the end of the tunnel. It might not all be cut in 2025, but if there is like, hey, by 2026, we're expecting the interest rate to be around 2%, something like that, something very bullish and optimistic, I think Realty Income in the next 365 days should be $75 a screen, or $75 a share. I know I sound like a maniac, I sound like a loser, but based on my math and calculations, that's what I think. But on the conservative side, I always have to shave my numbers a little bit and use risk-adjusted numbers. $65, super realistic. And then after Realty Income, I think my next highest conviction, because Realty Income for me is an S-tier stock. I feel like if you're a beginner to the stock market, if you don't know what the hell you're doing, and you just want a good company with a very solid background, history, and timeline, provides a really good dividend, I think it's Realty Income. It's so easy that even a stupid person can invest into it and walk away being in the green in the long term. Obviously, if you bought into them in 2021, 2022, 2023, you're probably like, dude, this thing sucks. It smells. But you have to understand that REITs go through cycles, market cycles. And right now is just not a very good time for REITs. Which for me, I applied a hybrid approach, right? I do value investing, dividend investing, and contrarian. Dude, that was disgusting. I like spit out of my mouth. But and a contrarian style of investing. When people are fearful, then I start buying. When people are absolutely greedy, then I don't go near that stock. Because REITs are beaten up and they're undesirable and they're ugly, I think right now is the opportunity to buy into them. That's my own investing philosophy. For you, if your risk tolerance is really low, just like mine, you might stay away, and that's do you, right? Do you, boo-boo, as they say. But for me, I think in 10 years, I'll be super happy that I continue to pick up shares of Realty Income whenever they trade below $53 a share. So under $53 a share, $52, $51, I think it's a really good price to dollar cost average into realty. I'm not saying I'm going to put my entire net worth into realty at $53, but I'm saying like every single time they go in the red and they trade for like $51.20 or even $49.50, then I'll continue to just buy 5 shares, 10 shares, 6 shares, something like that. I don't believe in doing lump sum investing, although for some people it's easier and you don't run into mental fatigue of trying to time it perfectly. You just say, okay, whatever price it is, Monday morning, I'm buying all in. It makes sense. But for someone like me, I like to buy into companies on red days. That's also a part of my contrarian strategy. But after Realty Income, I think the next best opportunity on this list right now is, funny enough, a toss-up between Nvidia and Domino's. Now here's the funny part. If every single one of these companies were at my buy price target, and they're all trading for the price that I think is a good time to jump in, all else being equal, then I think that would change things up a little bit. If that were to happen, then I would say Main Street Capital at $39 a share and Realty Income at under 53 bucks, solid bargain steals. But then second place, the A grade tier. If Realty Income and Main Street Capital S tier, then I think Nvidia and Domino's is still in the A tier. I think those are still very good, bang for your buck, good price to buy into them. And by the way, before I end this video, I just wanted to say something. Before I started to show my face, every single time that I uploaded a video, I would gain subscribers. It's a pretty cool feeling. Now, in the past few weeks or so, I started to show my face. I was like, you know what? Let's do it. Let's just show the people what I look like so they can put a face to the voice. Every single time that I upload a video without fail, I lose subscribers. It's a weird phenomenon. I don't know what it is. I woke up this morning, I checked my YouTube dashboard, the analytics, and I looked at it, and I'm not gonna lie to you, I felt a little insecure. I was like, what is going on? A part of me is like, maybe it's because I have a baby face. I'm in my mid-30s. People legitimately think I'm 18 or 19, and that couldn't be farther from the truth. If you at least said 22, okay, you're not that far off. But I'm in my mid-30s, all right? And I think it's the baby face not doing me any justice. Because based on my data, the average viewer of Dividend Compounders with Cheese is 56 years old and is a male. So to see someone that looks visually like a 22-year-old, that has the voice of a lesbian that's like 5'7" and is always trying to do a dick measuring contest, whatever you can do, I can do better. We all know that individual. They don't have to be lesbian or straight, but we all know that one person. You can't say a single thing around them without them trying to one-up you. Super annoying. But I don't know. What do you think it is? Is it the face? Is it the ethnicity? Is it the voice? I keep losing subscribers past 3 weeks. That's only been happening in the past 3 weeks. I otherwise don't lose subscribers. I usually gain subscribers with each upload. All that to say, if you enjoy this type of content, let me know by commenting on this video. That's the reason why I even decided to continue this series, because a few of you left comments. That's the power of supporting a small YouTuber. I read your comments and I implement and I put it into action. Because some of these big ass YouTubers with millions of subscribers or hundreds of thousands of subscribers, whenever you give them feedback or you comment on them, dude, they just straight up ignore us. But that's not the case with Dividend Compounders with Cheese. So if you like it, let me know. If you don't like it, let me know. I welcome all feedback. Anyways, I love you guys. Stay safe and good luck in the stock market. Peace.